All right. So, our presenter today is an ambitious visionary with a desire to raise up others to achieve their full potential. He's a former Microsoft employee, but still works within the sphere of Microsoft technology and takes every opportunity to help others find solutions and achieve greater productivity using the tools available. Outside of his 9 to 5, he has founded skillswordsman.com and the Learn, Grow, Invest Club. He also maintains a personal YouTube channel, one for the Learn, Grow, Invest Club and one with his wife, while maintaining all their social media pages. He's a teacher, a premarital counselor, a husband, a leader with a true passion for learning and a gift for teaching, which he uses to inspire others. This mostly self-taught investor enjoys seeking out knowledge and applying the knowledge gained. But more than that, he enjoys sharing what he has learned with others. This evening, we get to benefit from that passion as we welcome my husband, your founder, Jermaine McDonald. Welcome.
So thank you, Renee, for that. It is great to share with you guys here today. So what I'll do before I start, since I know that for our meetings, we typically get one or two new persons. So I wanted to just get an idea of the type of investors that we have here today. All right, so mostly beginners is what I'm seeing so far. There, there's no beginner-ish, guys. You're either a beginner or you're not. The reason why I asked that question, right, is we're talking today about understanding your investment profile and how to use that in terms of formulating a strategy in investing. So understanding where everybody is will help me to kind of tailor the things that I share today. All right. Okay. So I mean, this slide is very just kind of for just to get it out there, just in case there's somebody here who is completely brand new. The idea and the concept of investing is essentially allocating resources with the expectation of what we call returns, right? So that's why, I gather most of us would have started investing where we're expecting to receive some return on the money that we would have invested. But the concept of investing is not new. Persons would often say, for example, invest in your education or invest in that in building your career. So the principle of investing should not be new to anyone. But for completeness, I thought that I'd share it. So the concept of investing really, and for each of us, the motivation might have been different as to why we started investing, but the goal for all of us would be the same, where we're expecting to receive or get from the market or the instruments that we invest in more than we've put in. And within the presentation, I'll speak about things like our time horizon and cover things like risk that would factor into framing that expectation. All right. So I wanted to kind of leave this here to just kind of go into even the reason for presenting this particular topic. So within the club, we talk to a number of persons who try to achieve their investment goals. And for a few persons that I speak to from time to time, the question is, which stock do I buy? When do I sell it? Where do I invest? What do I do with this? I have $10,000. How do I spend it? And the questions kind of follow the theme of not really being sure what to do or where to put their money. Or you may see, something come out that says, this stock did well, and you're like, well, if only somebody I knew told me to buy that stock, then I'd be in good shape. And before we give any investment recommendation, we typically ask a few questions to try and determine what makes sense to recommend. Because as you will see later on in the session, we'll talk about formulating the right strategy based on your risk profile. And though we may see stocks from time to time that do great, it's actually okay, I think, to miss certain opportunities if that particular stock did not meet our requirements in terms of the potential or the variance for risk within that stock. And what I mean by that is, if you see, for example, a stock doing 200%, but that would have been an extremely risky stock to buy, and you're a conservative investor, then you just have to accept that you're missing that opportunity, because though the potential would be great for it to go from 200 to 400 or even more, you can't manage the turmoil that comes with that price being $10 today, $5 next week, and $20 the week after. So it's very important to understand what your risk profile is as an investor, especially those who would have been investing for a year or less. All right. So the top reasons why investors fail, according to motleyfool.com. I don't know if you guys are aware of that site, but I'll share all the links at the end of the presentation for you. But these 5 things are according to a poll they would have done. And you see it on the screen where they're trying to either buy the stocks and not the companies. And that's a very common thing that we see, where if the first thing you ask is which stock do I buy, then you're going about investing the wrong way. And I say that with absolute respect. But if your first question is which stock do I buy, then you're definitely not approaching investing in the best way. If you say that this type of investor, I'm looking for this kind of return, are there any stocks that meet what I'm looking for? Then I think you're asking the question the best way, and then the person you are speaking to can then advise you accordingly. The next thing which benefits investors who are more patient is typically that you benefit from compounding. And for those who are unaware, compounding simply means that you're able to benefit over a long period, where let's say that you start with a stock in year 1, and you'd have received 20% for that year. You leave that 20%, and then the next year you get 10%, then you get 5%. You're benefiting each year from the interest that would have accumulated on that initial investment. So the idea is that the longer you're able to leave your money in an investment, then the greater the possibility of compounding. Now, we're talking not just stocks. I know most of us here are probably familiar or most interested in stock market investing, but the principle of compounding can apply to other things as well. The third reason why they have here is that most persons are actually of the mindset that they don't have enough to get started, and that's a question we actually hear a couple of times in our monthly meetings, where persons are like, I only have $5,000. What can I do with that? It's okay to invest with $5,000 or $10,000 or even $1,000. Really, it depends on the shares that you're buying and what the minimum buy is. Now, I think for us, we have gone down to being able to purchase one stock. So just the mindset that you can start with as little as you have, but you just want to be consistent and intentional with how you invest. The fourth point is that most persons are really very afraid to lose money. And I see even persons who are aggressive get very, very nervous or jumpy when they're up 100% today, and then they see it at 90% tomorrow, and then they start to sweat, and they want to sell everything because they don't want it to get to 80%. And again, after today, hopefully that will help. If you are typically nervous when you see your investment start going down, then hopefully after today you will understand how to treat with those situations. And the last thing, there are persons who just don't know where to start, and that's where we welcome everyone, regardless of your investment experience, to be a part of the monthly meetings and to ask us, because we'll definitely willingly help you to get started. Your investment profile is extremely important, and we're going, for the purposes of today, we're going to cover a few reasons as to why it's important. This is not exhaustive, but I'm just going to go into why it's important to know what your profile is, right? So it limits the mistakes that you make as an investor. So if you're identified as a conservative investor and you identify a particular stock or asset to be one that is riddled with risk, or it poses things that may cause a challenge to your particular investment style, then it would make sense for you not to engage in that particular investment, because then it wouldn't fit what you're looking for. All right. Are persons still able to see the presentation? My screen blacked out for a sec, so I just want to be sure that you can still see it.
I can see it.
Okay. All right. Perfect. Okay. All right. So the next thing that it allows you to do is, and this is something that I had to do personally, you can pretty much train yourself to invest in the way that works specifically for you. And what I mean by that is, so for example, my particular profile, so I am what you consider an aggressive investor. So what that means is that there are times when I am actually more passive in investing than I should be, because emotionally I may be nervous as well. And I'm like, well, no, the nerves that I'm going through, or the things that I'm feeling regarding loss of money, is not as important to me as the returns that I'm hoping to get from the investment. So I have to remind myself to not be afraid to lose money, because I don't care that much if I lose money. I more care that I benefit from the particular investment. So that sort of mental conversation I have with myself will be important, because I understand that I am not a conservative nor a moderate investor. I am a very aggressive investor, and it doesn't matter to me if I have a short-term loss. I'm willing to ride that out and just average down, and I'm fine. But without kind of understanding where I stand in regards to that, then I may not take advantage of the opportunity, or just give in to, just being afraid to take that particular chance, because maybe, it went down 20% today, and I'm a little bit nervous to even share with my wife that our portfolio may be down a few $1,000s. So you can train yourself essentially based on what you know of your risk profile and your investor profile to make better investment decisions, right? So I'd said this before, overcoming the psychological impacts. And this happens with everyone. And for persons who are seasoned investors, they will probably tell you that they had to overcome the challenge of their first loss, or the challenge of hearing that the market is down 30-40%. At some point, every seasoned investor had to overcome those things. It's just that they maybe went through it enough times, and they're able to understand that it just comes with the territory, right? The next thing that I mentioned in terms of training is that you can actually tailor your investment strategy based on your identified profile. So, again, for me, because I care about aggressive growth, I can, identify and work with stocks that have great profitability potential, and not so much the ones that are considered, solid blue chip companies. But and I'm not saying that's the right approach. What I'm saying is that's what I've identified for myself, and that's how I know how to manage my investments. And then, finally, in terms of this point, you can ignore the noise. And what I mean by that is, if you're on social media, if you're in a group, you may see persons who talk about stocks or investing, and it's something that we all do. We share our wins more than our losses. So when we're in a group and we're hearing everybody saying, I bought this when it was at $10, now it's at 20, golden, but they don't share the fact that they bought something at 10 and now it's at 5. For you who are observing, you're like, well, I'm not having that same experience. I'm not up in the same way. And you start to feel as an investor like you're not making the right decision. And then you may find yourself selling to go into a stock because you hear it's going well, and then the next week it's not doing as well. So for those, for example, who would have bought into a stock like Key Insurance when it was at $10, and I think now it's back at 4 or 5, there's always somebody on the opposite side of a trade. So for you to sell a stock at $10, somebody has to buy it. So when it goes from 10 to 5, there are persons who would have bought at 10 that now have to decide whether or not they should keep or to sell, right? And the last point that I'll state here is that you'll be able to set the right goals. So and I'm setting this framework for the beginners, especially because this is how I want you to take the information that I'll be sharing today, use it to your advantage, and make the decisions that best suit you. All right. And that I don't think I need to get into what SMART goals are. I think everyone is familiar at this point. If you're not, just type it in the chat and I'll address it later on. All right. So in terms of investment profiles now, a profile of an investor is simply the preference of the investor. So I'll ask for persons here, is there anyone who don't know what their investor profile is? So for example, if you don't identify yourself as either conservative or moderate or aggressive, do you not know, is there anybody who doesn't know what their risk profile is or their investor profile is currently? Okay. So as I was saying, the profile is simply your preference. So for example, I would have gone through the steps to identify what my investor profile is. So I know, for example, I've identified things as the target profit that I'm looking for. I've identified the period of time that I'm looking to invest for, and I understand completely what my risk tolerance is. So for example, I can share an experience where for me, there's some stocks in my portfolio that I'm down now 95%, and that's okay for me because it's something that it's not close to my time horizon. So I have time, and I would have understood going into the investment that this was a risky investment. So there's this common saying that you don't invest what you can't afford to lose. But of course, that doesn't necessarily give you comfort if you're a new investor and you're like, well, I'm trying to invest to make money. I can't really afford to lose money. But again, with the understanding of what your profile is, you'll be able to handle those things. So there are 3 main investor profiles for you to be aware of. They are conservative, moderate, and aggressive. And within most brokerage firms, they'll actually maybe tweak these a little bit. So you have moderately conservative, or you have you have moderately aggressive, then you have very aggressive. So, but these are the core. So everything kind of stems from these three. We actually did a poll on our Twitter page as well to kind of assess, persons their investor profiles. So I mean, the leading selection was moderate, and that's where you find most investors. But that's not to say that's the best profile. So in terms of determining which one you are, that's what we'll get into. But in short, a conservative investor is one who is looking to balance the need for capital preservation with risk. So somebody who's conservative is usually one who wants to know that their cash is readily available. So if they're investing now, they want to know that maybe 3 months from now, 6 months from now, I can get 100% or as close to that number of my investment back. So there are persons who can't really stand volatility, and volatility means any major shift in asset value. And I say asset value because, again, I'm not just referring to stocks here. And that's why you will see, for example, persons mention like real estate being a better investment than stocks because it's less volatile in terms of prices. But again, I think when comments like that are made, it's not factoring in the purpose or the reason for acquiring the house in the first place. So it's really based on you, the investor. So my reason for buying a house and your reason for buying a house would be completely different. For a moderate investor now, they're more interested in, well, they're a little bit more comfortable with risk. So all investments are risk. Let me just be clear with that, regardless of type of investment. But a moderate investor is almost like 1 foot in, 1 foot out. So I can take a little bit of risk, but I may not risk all of my money. I may risk like X amount, or I may try to balance my portfolio where I have some stocks that are really poised for growth but can be volatile, and I may have some blue chip, or I may only focus on like real estate because I can't deal with the volatility of stocks. So the moderate investor is kind of positioned in that way. The aggressive investor, on the other hand, though, is their sole focus is profit. They're willing to handle fluctuations in price. They're willing to even manage their expectations of liquidity, but their sole focus is profit. And as I said before, that is what I've identified my personal risk profile is. So if you should ask me, for example, which stocks or which investments I go for, it would be very different because I took into consideration my personal preferences, and I'm just interested in getting as much profit while I can, especially while my income, my circumstances remain where they are. So if things change for me, for example, if I change jobs tomorrow, and maybe I'm earning less, then those priorities may change. If I change my circumstances in terms of health, that may change. If other things that impact me, such as maybe the job status of my wife or anything relating to me that impacts my ability to invest, can modify that perspective of taking on a more aggressive approach. But all three, who you are is just who you are. So there is no wrong way to invest. If you are conservative, you just need to be mindful of the ways in which you need to leverage that conservatism, or if that's a word. And if you're moderate, you want to be sure that you have a more balanced portfolio than, because so for example, if you're a moderate and you have, for example, only bonds in your portfolio, then you're not really taking advantage of the fact that you're okay with taking on more risk, right? So two key concepts we'll look at before we get into how to calculate or to determine your risk profile, and we'll get there very soon. Two main things you want to be aware of: your time horizon, and that's the period of time you're expecting to hold the investment for. So if you, for those who would have been investing for a year, what should have happened, for example, when you first opened that brokerage account, you should have had a broker or an agent ask you, what are your investment goals? How long you want to hold the investment for. They might ask you what your income is, things like that, to determine your appetite for risk and how long you're expecting to hold that investment for. And then based on that, they would tell you what to put in your portfolio. Now, where most investors go wrong, and this is what I've seen, and an agent may ask you, how do you want to manage your portfolio, or what's your risk appetite? As a brand new investor, you should never be asked what's your risk appetite. You should be asked the questions that we'll cover, but you may not even understand what your appetite is if you've never invested before. Meaning, you may think that you're conservative, and for example, I'll let me see. I was going to use an example, but it may not be appropriate. But I was going to say, you may consider yourself conservative, but in certain aspects of your life, you're a high risk taker. That means you're not a conservative person, or you're not conservative in terms of investments. It could just mean that you don't understand them enough to want to take that risk. But so, for example, if you're, let me use a really bad example, but let me say, you think you're conservative, and yet you may like, fast cars, or like to drive fast. You're kind of prone to taking that risk that comes with driving fast. But then you think, regarding, because that's risking your life essentially. But you may not be comfortable, putting $10,000 on an investment because you're not sure, what will happen. That simply can change based on your education, right? So learning more about how it works, what to expect, how to manage it, can take away some of that uncertainty and make you more prone to making a more deliberate decision. All right. The next you want to think about is your risk tolerance. And what that means is just your ability to be emotionally stable when there's a variance in that asset value. And again, that really comes with experience and knowledge. So for example, the longer you are investing, and you guys can let me know in the chat how it works for you. But what I found, the longer I'm investing, the more tolerant I am of risk as it relates to investing. So I remember the first stock I would have bought locally, that would have been VMIL. I would have bought that stock, and I shared this story with our group before. When we bought that stock at $2.33 at IPO price, I remember the first few months it went up maybe as high as 420, 415, thereabout. And that would have been almost 100% profit. And we were like, okay, it's cool. But at the time, I would have been speaking to somebody and they were projecting that stock to go somewhere around $7.50. So I was like, well, okay, $7.50, good. Let me keep holding because it's not anywhere near that yet. And at the time, I only thought stocks went up. I didn't think about them going down. So when it started to correct and go down to about 380, 390, they're about 350, I started to get a little jumpy. I was like, it's going back down to where I paid for it. And if you're a new investor, when you see that first surge, then it starts to go back down. You're like, and worse, every day you're checking it, it's less and less, or you may see it spike and then it go back down and close lower than it did the day before. You start to feel that you start to sweat bullets. And I ended up selling maybe about a very large amount of that position. So let's say I had 100 units. I sold about 80 units at $3.45. And most of you would say where VMIL is now at about $7.80 after about two plus years. So though the amount that I held is still a fair amount, I left a lot of money on the table by just not understanding enough at the time that those fluctuations in price are normal. And that's something that you learn, that if depending on how you watch your portfolio or how you manage it, if you try to track daily, it's different than if you track monthly or even quarterly. When you track daily, it's more of an emotional roller coaster than if you should track monthly or even quarterly, because it may start the quarter at $5 and then the quarter at $5, but in between it went to 7, maybe went up to 9, then went back down to 3. And so if you're tracking it daily, you'll feel as if it's more volatile than if you take a step back and look at it at a higher level. And that again just can set your expectations for risk. So those are the two key things you want to determine what they are for you. So each and every person in this meeting now should know what their time horizon is and what their risk tolerance is. All right, and you can expect those things to change over time. So for example, if your time horizon for, let's say you're saving to buy a car and you want to invest and your plan is to buy the car in 6 months, then that time horizon is 6 months. If it is that you're saving to buy a house and you're hoping to buy it in 5 years, then your time horizon is 5 years. If it is that you invest and you're not willing to lose any of the investment, then you have what's considered a low tolerance for risk. If you invest and you're willing to lose a certain percentage, let's say that you're willing to lose 10 to 20% of that investment amount, then you'd have what's considered a low to moderate risk tolerance. But if you're willing to lose up to 50%, then you have maybe a higher risk tolerance. So those are the key things you want to remember. We'll get to the meat of the calculation soon. I'm just laying the foundation, right? So in terms of investment strategy, the two things we would have mentioned come into play: your time horizon and your risk tolerance. So I'm going to show you on the next set of slides how to calculate that profile by asking specific questions, writing down the answers to those questions. And then you have a lot of sites that can generate it automatically for you. But I actually don't agree. I have not seen, in preparation for this meeting, I went through quite a bit of investor profile quizzes, and they all seemed a bit incomplete to me. So I'm going to show you some, and I'm going to say to you what I suggest you factor in. So the reason why I'm not showing you a particular, I'm going to show you actually a sample for a local broker, but I'll show you also what I think you should add to it and what you should kind of take with a grain of salt. But the key thing to remember is once you understand your risk tolerance and you have a time in mind, those two key things will make up your profile, and that will determine your risk strategy or lead to a more successful strategy. And again, the link below would show where I got this particular graphic from. All right, so these are the questions that you need to ask to determine what your investor profile is. And we're kind of going to go through them one by one so that I can help you know how to calculate it yourself. As I said, I will share the links to the different quizzes that you can do it automatically. But just know that any quiz that I'll share with you won't be complete. All right, so the first thing you want to understand are your goals. And I would have stated that before. So your goal is, for example, you make 100,000 per month, you have 10,000 disposable income, and you want to be able to buy a house for 5 million or 10 million in 5 or 10 years. That's your goal. So as someone would have mentioned in the chat in terms of SMART goal. It's specific, it's measurable, it's achievable, it's realistic, and it's time bound. So that what I just mentioned would have met all of that criteria. It's specific in that I want to buy a house. It's measurable, meaning I know what the amount is. I know how much I can save per month or invest to get there, and it is achievable. The achievability is really determined by how much you're actually able to save, and factoring in what the average rate of return is for the investment that you're doing. That will determine how feasible it is. So for example, if I'm trying to save 10 million in a year and I make 100,000 per month, that's not achievable at all. Like that's not even remotely possible. And it's the time bound would just again be factoring that time. So the time horizon, we would have discussed that already. How soon I will spend the funds is very important. So what I find as well, persons who invest, and this might have happened to you as well. So you bought a stock, you sold the stock because you're planning to sell it at X price, and then your funds just kind of sit on your brokerage account for months or years and nothing has been done with it. And this happens a lot because persons don't know what to do with the money. They don't know what to buy, they don't know what to do. They're not really comfortable with what they're seeing in the market, and they're kind of unsure where to go or what to do. My encouragement to you, so a part of my strategy, for example, I do keep cash on hand to be able to take advantage of certain investments, but I'm doing that, for example, in this time during COVID, because I think there'll be an opportunity to take advantage of some deals very soon when certain factors align. That is an intentional keeping of cash for that purpose. Contrast that with somebody who just has cash on their account, has not had a plan to do anything with it, or say, let's say they started the investment 2 years ago, they plan to sell it in 2 years, it's now 3 years and you've done nothing with it. So understanding what that will be. If you don't have a reason to spend the money, don't spend the money. If you don't have a reason to withdraw the investment, transfer it to a different asset class if it is that the instrument that it's in is not favorable right now. And what I mean by that is, if stocks are too volatile, shift it to bonds. If bonds are not giving you the returns that you want, shift it to maybe foreign exchange, whatever it is, but always have it in an instrument that is giving you the returns that are acceptable for you. Now, if you're conservative, then you want to keep a certain amount of cash at all time because that's important for you, and we would have discussed that before. The next thing is, what's your investment knowledge? Now, investing is not for everybody, meaning daily watching of the markets or daily, digging into what's current. That's not for everybody, and that's okay. But you should still understand how to invest, meaning if you're conservative or you're one of those persons who prefer to have a broker make all your decisions, that's okay. But you should understand the concepts, understand where your money is going, so you can make the right decisions, because a broker will only be able to do as much as, one, you allow him to, or two, based on the initial profile he took of you. So if you started out being conservative and your risk profile changed and you didn't tell your broker, they're not going to know any different, and your stock will stay in that bond for the foreseeable future, gaining 5 or 10% per year at best, unless you say, well, I'm a little bit more experienced, I like to take on more risk, go ahead and transfer it to something else. So you have to be in a position to make the best decision for you, because a broker is managing multiple customers, multiple perspectives. So he's not always going to give your account the attention that you would. And the next thing that you want to ask is, what's my state of mind after I invest? So if you invest 100,000 and you're watching your account daily, you're watching that balance daily, then that emotional kind of mindset. You want to either bump up your knowledge or try to not have that kind of factor into your decision. And what I mean is, you invested 100,000, the stock goes down by 5%, so you withdraw the money. And then, I ask you why. You're like, well, I lost $5,000. I was like, no, you didn't lose it. It's called an unrealized loss, meaning you lose after you sell, you gain after you sell. So unless you have not transferred that asset value back to cash, it's what we call unrealized gain or loss. The next question you want to ask is what's currently in your portfolio. So what's that portfolio mix? It goes into the concept of what we call asset allocation. That's not the topic for today, but essentially, with all the different forms of investing, meaning the different instruments like stocks, cryptocurrency, bonds, real estate, gold coins, other things, maybe art, whatever it is that you can invest in, will make up your entire portfolio. Investing in stocks is not the only thing that you can do as investors. And with experience, typically persons will start to look to other asset classes to diversify that overall investment, because there's this thing that we call correlation. So, for example, the theory is that, or the practice is actually is that typically two different asset classes, if they're not correlated, then that's a good opportunity to diversify. And what I mean by that is, if it is that the price of, let me see if I can consider a good example. So let's say that when let me use gold, because I think most of you might have seen that Money Mondays by maybe Kalila that mentioned gold. So there's this thing that says if two asset classes are correlated, typically you don't want to invest in them together, because if one goes down, the other goes down as well. But if they're inversely correlated, when one goes down, the other goes up, and then that's a good opportunity to diversify. So that is something that more intermediate or advanced investors will look at, where you try to diversify your portfolio, so that if one asset class goes down, then the other can shore up in terms of those losses you may be experiencing in one, and it helps you to manage the state of your portfolio, and it helps to protect you. And that's something that we can get into for another meeting, but that's not the focus here today. The next question is your income stable? Stable means that, for example, if you're in an industry now during COVID that you're at risk of losing your job or your salary has been cut, that factors into what your preferences for investment would be. So if your income was $10,000, now it's $5,000, your disposable income is less, and so you're less likely to invest in the same way. And that's okay, because your reality is your reality. So what you need to do is adjust your expectations, adjust what you would have committed to, and then make the necessary adjustments. So if you're experiencing, let's say, even work, if you run your own company, let me use that example, and you don't have a set salary, what you can do is invest based on a principle. So for example, 20% of what I make is invested is a principle, versus saying I'm going to try and save $20,000 when I may not make $20,000. All right, so that's something to consider as well. What types of returns do I expect is very important. I see a lot of beginner investors expecting, back last year when things were very profitable and lucrative in terms of IPOs, a lot of persons had expectations of 100% after 2 months or 200%. I'm not going to say that's unrealistic, but the circumstances should dictate the returns that you expect. So there are stocks right now that are doing very well, but if you had the expectation for them doing well, depending on the industry and what would have happened, it may not have been determined to be realistic based on what really what the current climate is like. So always try to temper those return expectations based on what is realistic. It doesn't mean you won't achieve more, but having the right expectations can help you temper how you manage your investments. Because if you're expecting 200% in a climate that says on average the best return will be 20%, you may either find yourself having to do more trades or be doing more to get to that 200% that you've set, or you can set a more realistic goal, then you don't have to monitor it as much. And last question is, do the debts that I have impact my ability to invest? It's completely possible and within your right to invest while you have debts. So for example, for me, I'm not debt free, and that's okay with me. I don't believe that I need to clear all my debts before I invest. I don't see a rule that says I have to clear those debts, and that's okay. What my position is that the returns that I'm getting from my investments outweigh the debt that I have. So if it is that I'm called on to clear those debts, I can. But I'm comfortable with what I'm paying in terms of returns versus using that money to invest. And what I mean is, if I make $10 per month, my debt in its entirety is $8 with interest. I'm comfortable paying maybe 50 cents per month and paying that off over 2 years and maybe paying $14, $15 at the end of it. But if I'm getting from that $10, maybe $40 return over the same 2 years, to me, I would have been, in a better net position than clearing that debt and then getting a later start on my investment. And to each, it may be different. I'm not telling you what to do, but I'm just saying your debt and that position can impact your ability to invest. So what that could also mean is that, let's say I do have that same debt for $8, which is costing me in terms of a loan of $2 per month. It may serve me well in one instance to clear that debt so that I can free up that $2 to invest. However, there's a trade-off where there are debts that if you clear them sooner, there's no great benefit. Meaning, let's say it's a 5-year loan and you're 3 years in, you would have paid off all of maybe like 80% of your interest already. So clearing it off quickly, just because you're not comfortable with the debt, that opportunity cost of not investing those funds now would have probably given you less returns. And hopefully you understand what I mean. So it really depends on the debt. It depends on what you're paying monthly. It depends on the tenure of the debt. And all the other things previously would have been a factor as well. So if you have like a student loan or a credit card debt, and you're at the point where if you look in front of you and the debt is a large chunk in terms of interest, it may suit you to pay it down. However, if you're on the tail end of the debt and there is no great incentive to clear it, it may be best to keep that debt, manage it well, make sure you pay it on time and not incur any late fees or anything, and invest while you take your time to pay the debt. And that is my personal approach. So I manage what's called my net worth in a Excel sheet that I track from time to time, and I look at my debts and make a determination as to, okay, if I have a lump sum of cash, do I clear that debt? I'll say, well, I have $10 left on it, 2 more years to pay it. I have $20 now, but if I invest that $20, I may get back $40. Okay, all right, I'm not going to pay it off because there's no great incentive. Because again, I have no other purpose for that money. So if it is that I have a stock that maybe is a little bit more attractive to buy now, then I may even try to refinance that debt in some cases free up more cash, and then I'd invest in that. Sure, I'm paying a little bit more on the debt, but I would have freed up cash to be able to invest. So those are the questions and the thought processes that you can go through to determine what your profile is. And so I'm going to show you an example now of a questionnaire, and the link here that you see is for Barita's roadmap tool. For those who are regulars here, you should know about this tool. We've actually went through it before, but I'll post the link in the chat afterwards, and I'm going to take you through the questionnaire and tie back everything that I would have said so far to those same questions, and show you at the end of this questionnaire what the Barita tool determined as my investor profile. All right. So I'm hoping that you can see this. It's a screenshot that I took. Can everybody see it okay, or do I need to zoom in? Maybe. If there's anyone who can't see it, just let me know. But if you go to barita.com/roadmap, it brings up this tool. So the first thing it asks you is what your goals are. And I would have typed in, for my personal goal being wealth, I put in my age. And age really is something that they take for a couple of reasons. One, your age kind of speaks to maybe your life stage, or it speaks to, okay, all right, Malika, let me escape and try and zoom in. Let me that, and let me do this. Is that better?
Hi. Yeah, that's good. Thank you.
Okay, cool. All right. So that's of my age. So if there are persons on the call now, you're maybe 25 and under, that bodes well for you, meaning in terms of just maybe your time horizon, maybe 10 years, 20 years. But then it doesn't mean if you're on this call and you're 41 to 50, or you're 51 to 65, that necessarily is a bad thing, because maybe when you're older, you have less concerns, or less, yeah, you're more inclined to take risk, because you're like, maybe I've lived or I've been through certain experiences already, and I'm not so concerned if I lose this, because I would have paid off a mortgage, or I'm at a certain stage where I'm comfortable taking on risk. But they would typically ask your age to kind of understand, some kind of key in some factors about who you are. Next, it will ask you what you currently have in terms of assets, right? So this includes your bank accounts, your credit union balance, any assets you may have. So this is a very important question. So for example, some persons may be saving from they're in high school, or they know, for example, their parents may be leaving some money for them, or they have a vehicle that's in their name, or a house in their name. All of that add up to your financial position. All right. The next thing they look at is your annual household income. What that means is, for example, if you're married, what is your cumulative? So if you make $10 and your wife makes $10, and your income is 20. Now that may be debatable by some. You may say their money is their money, your money is yours, but that's not the purpose that we're going for here, right? But that factors in, because some of those expenses can be shared, and it is to your advantage when you have the ability to leverage someone else's income. And when I say leverage, I mean exactly that. So if you have, if you are sharing income with someone, you can maybe position or manage your expenses in such a way that you're able to maybe free up one salary to focus on investing, and the next one to take care of the fixed expenses. And so you can use those things to your advantage, but it does factor into what again, what you may be prone to do. So someone who earns less than 2 million would be different than somebody who earns over 8 million. The person who earns more than 8 million would be maybe in a different, so let's say if you earn 8 million per year, chances are you drive a certain car, or you live a certain place, you have a certain lifestyle that you maintain, so your investment expectations would be different. Versus if you earn less than $2 million, maybe you're still living with parents, or you're sharing space that you're renting. Whatever it is, the point is your income determines your investment goals, right? So let me go to the next slide. From there, they will then ask, what's your primary investment objective, right? And for me, for the purposes of this exercise, I chose that I want to generate income, but I also want to see my investment grow over time. And again, your reason may be different, but the idea behind this, and this is what I would have chosen personally if I was doing this the right way, and that's because my personal strategy is one, to leverage dividends. And if I have the ability to get dividends while realizing capital appreciation, that's a win-win for me. Some persons want to focus completely on preserving their capital at all costs. That's okay. And another person is just focused on capital growth, and they don't really care about dividends, meaning you're not banking on dividends, because as you know, dividends aren't guaranteed. It's based on the profits of the company. So if the company is not making profit, then you're not likely to get additional income, but it may be a stock that does well, so you're able to realize those gains. And it depends on what you're in for. So a stock may go 300% in a year but pay absolutely no dividends, and one stock moves 5% but pay consistent dividends. And one person may say, I prefer that, versus somebody who say, well, I'll take my 300%, and you can keep your X amount dividend check. It really depends on what your preference is. We would have mentioned the next question, how long you plan to invest. That is important. And again, this is if you're investing 1 to 3 years, and you would have stated like you're planning to generate income, I can tell you 9 times out of 10 they're going to recommend blue chip stocks for you if you have that sort of turnaround time of 1 to 3 years, because they're going to say, well, you're not investing for a long time. I know 3 years feels long to some investors, but 3 years is not a long time. A lot can happen in 3 years, sure, but in terms of investing, in terms of compounding, if you look, and the most famous investors that you know, they would have been investing for a very long period of time. So you want to take that into consideration. Now, if your goal is within 3 years, that's okay. You just want to temper the expectations based on how long you're intending to invest for. The next question is asking about your attitude in terms of financial risk. And as I said, how you answer this question, you should really assess. Don't go by what you think you are, go by what your actions dictate. So if you say you're a low risk taker, and then you examine your lifestyle and you're not a low risk taker, then it could just mean you're a low risk taker with regards to investments that you don't understand, which is okay. But you're not a low risk taker in general. So again, I would have known from my past experiences that I have a very high tolerance for risk, and so I would put here that I'm a very high risk taker, and that's okay. What that means though is that for me, I have to be very careful not to invest what I genuinely can't afford to lose, because I would go all in for a stock, and then tomorrow that stock is maybe down, and I'm like, well, okay, it'll go back up, and it may never go back up. So that stock that I mentioned, that's down 95%. It's been down 95% for the last 3 years. It has not moved in terms of its value. I haven't sold it. and it's still just sitting there. Maybe one day, I don't know, but one train of thought could be maybe take the 5% that's left and do something else that could have grown over the last 2 years. But I would have made up my mind to leave that value in that particular asset. And I'm willing to wait another 5 to 10 years to see whether or not it can grow versus transfer it out. And then I would have not, being able to realize that profit from it should it grow. No, I mean, again, that's a personal decision. There's no right or wrong. It really depends on your situation. Now, if I was absolutely without cash and needed that money, I would just cash out wherever it is and use it. But I have the benefit not to have to sell it. So again, it really comes down to that. I would encourage you, if you don't need the funds, as I said, it's better to transfer it to a different asset class than to sell it completely, because if you sell it completely, there's no potential for return. The next question is, how much of a temporary decline could you tolerate over a 1 year period? And this is one of those questions where I think I would actually add values to this that are not there. So I would say where it ends at more than 15%, I would say, what about 30%, 40%, 50%? Because most of you would have seen your portfolios dip 30 to 40% now. So does that mean you sell? It depends on those other factors that we would have mentioned. All right. The next slide, that next set of questions they'll ask you is what you expect as an average overall return on your investment over the long term. So you notice they're asking you here long term, meaning 10 years plus before tax. So look at the previous question, which would have given you options from 1 to 3 years and up. Now it's saying, what do you expect long term? So imagine a situation where your goal is 3 years, and yet they have figures here saying 10 to 12% or more than 12% over 10 years. And what that should show you is that, again, and this is just kind of to measure what your expectation is, because really and truly, if you are someone who say, I'm fine with 79% over 10 years, then what that should say about you is that you're a very conservative investor, and then you can just essentially invest in bonds. You'll more than meet that target over 10 years, and you'll be happy. You don't have much work to do. You just kind of sit and watch your portfolio from there. So the next question is as we would have mentioned, assessing your investment knowledge, which is very important, because if you state here that you have limited knowledge, then it means you're expecting your broker or your agent to make all the recommendations for you, which is okay. If you're more advanced in terms of knowledge, then you may have a different expectation. So I will have relationships with my brokers and I tell them what I want. I say, I'm looking for this kind of return. I want this strategy to be employed, and then we'll discuss the vehicles that fit that strategy. I don't have to ask them to recommend a strategy, but I would encourage you to have multiple sources of input in terms of strategy, because again, and this is not the same for every broker or agent, but because how they manage your portfolio may be different based on your other options, it would vary depending on how the mix of portfolio that they recommend. And you'll see that on the next slide, I think, where it states my portfolio mix based on the same questionnaire that I filled out. And then the last thing it asks, with statement, describe your current investment portfolio. So I would have put mainly fixed income securities from the perspective that I'm looking to preserve capital as best as possible. So with these questions that I would have answered and everything that we've discussed so far, before I go to the next slide, I'm going to ask you what type of investor profile you think you think Barita would say I am based on my options that I've selected? So you have three options. I'm either conservative, moderate, or aggressive. So Malik, based on what you've seen, you think this is an aggressive profile? That's interesting. Okay. All right, cool. So let's see what it says. So Barita's breakdown of my profile is that I'm moderately conservative. And that's actually what it is. Yeah, so Matthew got it right. This is a very, 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 very conservative portfolio, meaning that's in terms of profile. I would have selected things like, low appetite for risk in terms of loss. I would have selected a short time period. I would have selected also a low income, meaning in terms of what I'm making. So those things lend itself to somebody who doesn't have a high tolerance for risk and would want to preserve their funds as best as possible. So if you selected the options, and it's actually very interesting, Malik said aggressive, because a lot of persons meet the profile that I would have filled out, and their expectation is that of some aggressive returns. And they wonder why they would be frustrated with what they're getting, and that's because your circumstances or maybe the things that add up to your financial position don't make for for an aggressive strategy. Now, it doesn't mean that I can't be in that situation and have an aggressive approach. So for example, if I'm earning $2 million a year, but I live with my parents, I use my brother's car, I don't pay any bills in that house, I can have a aggressive approach. I can try to get, X amount per year above market average. But that again would mean my expectations in terms of what I invest in should change. So based on my profile, they recommend that I split my cash in the following ways. 20% cash means if I have 100,000, I keep 20,000 in cash. I put 70,000 in an income portfolio, income generating portfolio, and 10% in what they consider growth stocks, right? And on the next slide, I would have included all the, let me zoom back down for this one. So this is just now a summary of all of their different recommendations based on so what that questionnaire would have done is given you a score. And from that score, it determines what they recommend. Now, you can surely see the issue in that, because again, based on other factors, I could be somebody who's conservative and yet I have no interest in keeping things in cash. So I may say I don't want to keep anything at all in cash. So that's why your investor profile should be a guide and not a hard and fast thing, because you may be able to say, well, I know that I have a preference for being conservative. However, I want to use that available cash that would have been here on something else. I may choose to put 100% on income generating stock, but I may choose the type of stocks that are a little bit more, they'd have less fluctuations. So instead of keeping cash that may not generate anything for me, I'm able to get something, and I'm willing to say, well, hey, the stock may not grow much, but it's better than keeping it in cash. And then you have the different profiles here. So that's just, for context. So use that to your advantage. So the next part, I'm going to take a short break here to see if there are any questions so far. But next, we're going to talk about how to use everything we would have discussed so far to your advantage in terms of a strategy. So any questions, if you want to come off mute and ask them, I can break for a couple of minutes and answer those questions. Okay, all right, cool. So if there are no questions, I'll continue. So investment strategies now, considering everything we've said so far in terms of your investment profile, what strategy should you choose? And I think this is a part most persons are interested in. Now, for full disclosure, I employ personally different strategies at different times. As I would have said before, my strategy is based on what I perceive the landscape to be, what I think are certain key factors like, the state of my job, or, my preference for maybe owning a home, or, things like that. So having a strategy, you don't have to have one strategy, is what I'm saying. And there's no wrong strategy here. But what I'm hoping to do is expose you to the different strategies, and then you can choose and leverage them to your advantage based on the different things you would have identified in terms of your risk profile. So I'm going to share the link to the roadmap tool from Barita and some other investor profile questionnaires for you to use. I'll also share all the links for the different sections that I would have shared. I'll share it in the on the YouTube page when we release the video in a couple of days. So you'll be able to access the full articles and content from everything that I'm sharing here. But to go into the strategies at a very high level, so the concept of value investing, most persons might be familiar with that. So value investing is seeking to invest on what's considered the intrinsic value of a company. And that is really what you're saying essentially, is that you're investing because you perceive a company to be less than its true value. And there are actually some varied ways of calculating what that true value would be. So the idea is, for example, I take a company and I say, based on the balance sheet, based on the company, how it's managed, the sector that it's in, and what my prospects for that company may be, I foresee this being a $100 stock, but it's now currently selling for $20, and I'm expecting it to get to that $100 in 5 or 10 years. Then I'm likely to use this strategy to invest in that company. And again, taking into consideration my investment profile, I may say, well, okay, if I believe this would be a $100 stock in 5 years, my time horizon is around 5 to 10 years. I have a consistent source of income. I can consistently invest in this company. I can say, okay, this investment strategy works because of what value investing calls for. So don't call yourself a value investor if you're probably, trading that stock. And not to say you can't trade, right? Because trading is a legitimate form of investing, but it's not value investing, I think, if you're constantly trading the stock, because the idea behind value investing is that you're going long term. Now, I've seen some kind of modification to the value investing, meaning persons do look for value stocks, but they hold it short term. And that's because, again, the state of the market may say, well, if you get slight news that something is going well, the stock price shoots up. And that goes into the whole theory that the market may be overpriced at times, meaning maybe you're paying a premium. That's where it was last year in terms of persons paying a premium for the stock. So if you are a value investor, let's say a year ago, 2 years ago, you may find it hard to identify a stock because maybe things were trading maybe even higher than their perceived value, or multiple times what their perceived value would be. So that type of environment would dictate whether or not value investing is an appropriate strategy. The next one, growth investing, really speaks to you're investing in companies that are kind of positioned or poised for growth, right? So for example, you may say, these particular stocks are what we call growth stocks, or this asset is considered to be good for short term. So let's say you think of a company that's the next big thing. So maybe when Uber first came out, or persons who would have invested in Facebook years ago, you may have seen that stock as a potential growth stock. And so you invest with the expectation of growth, and that's a legitimate strategy again. But you would likely choose those kind of stocks if you have a higher risk appetite than someone who is, let's say, more conservative, because what it also means for industries that show high growth is that if maybe you have news that's not so favorable, then you may see a swing in terms of that price, and then you may have to contend with your portfolio going down depending on when you buy. Because again, what I would have said before, if a stock is overpriced and selling at $100, somebody has to buy it at $100, meaning if it goes down to 90, somebody is down 10%. At all times, for you to trade a stock, somebody has to buy it. So when you think a stock is not worth keeping and you sell, somebody on the other side thinks it's worth buying, so they buy. There are thousands of investors out there who are thinking the opposite of what you're thinking. So when you buy, somebody is saying this stock doesn't make sense to hold, I'll sell. So when you buy, you're thinking that it can go up. When they sell, they're thinking it can't go up anymore. So you factor that into your decision, because you can never say, if you go based on what the market is saying, meaning if everybody is selling, there are persons out there where I think, okay, it's a great time to buy. So that's just something to always consider, which is why you should never be, I think, too up or too down on a stock. It may not be a good time based on what the information you have is showing you, but the reality for that company can change over a quarter or over a year. So there are stocks right now that are not looking good at all in terms of outlook, but there's still persons trading them because maybe they're betting for 5 years from now. Maybe their time horizon is 5 years. Maybe it's a pension fund who, most of their clients are 30. So they're going to be giving them back their money when they're 65. So they don't have to worry about a company not looking good right now. They're thinking 30 years from now, they're a real estate company. Sure, they'll do well 35 years from now, right? Momentum investing is when you look to ride the wave. So again, I'd use the example of like a key insurance where it would have been seeing a rise, and when a stock first starts to pick up attention, you have to make a decision depending on your profile whether or not you want to take a shot, because especially if there's no plausible or known reason for that price to go up. And what I say when I say by that is there are persons who, for no, you have absolutely no info. There's always a reason, but you may not know the reason. So if you don't know the reason, you're taking more of a risk than somebody who says, well, I have knowledge that this is going to happen, or I have knowledge that this is going to take place. That person is not taking the same risk you are, who may not have any idea what's happening. But the idea of momentum investing is saying, okay, this stock has momentum, and I think based on the news that may be released or what's happening, I can ride this wave. The stock is now $5. I think it can go to 10, and then I can take some profit and then close my position. And that's something that happens a lot for persons who trade. They look for stocks that have momentum. They look for stocks that they can enter into a position, go up 10, 20%, close their position, and move on to the next one. trading, as I said, it's a legitimate investment strategy. It's not to be frowned upon. And I think without traders, the market would be very boring. So if there's nobody trading, if everybody bought and hold, the market will make for a very boring place. So if we all bought and all waited till we're 65, then the stock wouldn't move. So, for those who think that those who trade are impatient, or they just really have different priorities and expectation that you have. Their income may be less than yours, and they need money faster than you need it. Traders, to me, I believe, present a good opportunity to realize short-term gains, because trading can cause a stock price to move up sooner than it would have, because it's building momentum. And so even though I'm a long-term investor, for example, I may take profit short-term because I see a stock has momentum, and then I can re-enter my position when the stock corrects. So for example, those who might have owned Key from $3 might have sold at 10 and say, hey, well, for no reason, this was $3 last month, now it's $10. Let me take some profit, and I have no problem buying it back at $4 or $5. And that they would have been well within their strategy to do that, because there's an opportunity to leverage that short-term increase in price, right? The next one is called dollar cost averaging. Now, this is a highly recommended by me in terms of investment strategy, because what it says is that you're not looking at the cost you're paying for the stock now, especially if you have a longer time horizon than most. So if you're 35 and you're planning to invest for retirement, just pick good companies, dollar cost average, and don't track your portfolio except for maybe 3 or 4 times for the year. Just select the stocks you want to buy them whatever their price is with each salary, or with each period that you specify. And the idea is, let's say that you get your salary every 30 days and the stock price is at different levels each month. Over a year though, you may find that your average price is somewhere off the median value, where you say, well, yeah. So let's take the example of a stock like Fontana. It would have started the year at a certain price. If you've been buying end of January, end of February, end of March, you'd have had maybe an average price now of maybe around $6, for example. Whereas if you bought in January and held it and didn't add more to your position, you'd be down maybe 40%, because maybe you'd have bought at $8 or $9 including fees. But if you are dollar cost averaging every month, your net cost for Fontana would have been around $5 to $6, because if you've been buying the last 2 month ends, you'd have been buying around between $5 to $6. And if you don't understand the impact of dollar cost averaging, I can maybe talk somewhere about that afterwards, but it is a very powerful tool. So I would have been buying a stock for the last 3 years. It's a very expensive stock, but I've been buying it consistently every month from my salary for 3 years. So I have a very good position in the stock now. My average price is very reasonable compared to where the stock is now, because it's been gaining some momentum, and now it's way past maybe almost 300% more than what my average cost is. So now, because I've been buying it consistently for like 3 years with a certain portion of salary, I have a sizable position, one that I would not have been able to, let's say, buy 1,000 units of the stock in month 1. But if I buy 100 units or 50 units each month, 50 units each month is 600 units per year, is 1,800 units over 3 years. And that's a sizable position, as opposed to just buying once and letting it stay, right? And then you also have the benefit of dividends over that period. If it's a stock that pays dividends that you can reinvest. which is actually a strategy I highly recommend as well. So what that entails is that when you get dividends from a stock, reinvest all the dividends into the stock, and you increase the rate at which the stock compounds, right? Buy and hold is a very well-known strategy for those who consider themselves value investors. And what that says, you just buy it and don't sell, don't do anything, go through the different fluctuations, and 10, 20, 30 years from now, you benefit from the average rate of return of the market and that stock. So those who would have bought NCB at $10, even though NCB has gone from 230 now to 140, if you bought at $10, you're still up, a whole lot. But if you bought NCB at $210 and you haven't been dollar cost averaging, then you probably are feeling it quite a bit, right? And active trading is the last one that I thought I'd mention here. Oh, and I realized that I could have actually gone back full screen. So let me just do that. So the and it cleared off everything. Yeah, so the active trading is what I would have mentioned before. So active trading, as I said, it's a legitimate strategy. It's not to be frowned upon. I do personally key trades for the year. So I would have mentioned earlier, I'm saving cash, and what I do is I'll research a stock or a particular set of stocks over a month, over 2 months, maybe even over 3 months, and I'll say, okay, this is what I gather is the typical range for the stock to trade. This is the volume I notice it trades in terms of volume per day or per week. So I factor all of that into my decision to do a trade. So if I see a stock that trades on average 20,000 units per day, I'm not going to enter into a position for 50,000 units, because I'm not going to be able to trade that stock and sell it back within a day or two. Because if its average volume is 20,000 and I have 50,000 units, it's going to take me longer to close my position, and I'm likely to come out at a loss or lower than my target return, because the stock isn't liquid enough for me. So that's something that you want to you want to consider if you want to trade. And trading brings a whole different type of mindset. If you're a trader, don't get caught up in value investing. It's a different kind of process, a different kind of evaluation for companies. It's a different research method as well. And don't confuse trading with value investing. Trading is a form of investing, but don't confuse it with value investing, because I don't think it's the same. No, I do say that persons can use the concept of identifying companies at great value for trades. That's completely fine. But if your appetite for risk is such that you can trade more frequently, and you have short-term needs for cash that outweigh just being able to wait longer terms for money, then by all means trade. But I always say to those who I speak to consider it this way. Which would you prefer? Would you prefer to put consistently 10,000 on a stock each month? You'd have had 120,000 worth of units in that stock over 1 year, versus trading $10,000 for 2,000, 4,000 profit. So that's 40% maybe each month, but you have to commit 10, 15, 20 hours per week to earning that $4,000, versus just researching, picking that stock, adding to your position each month, and getting maybe that portfolio values 130, 140 at the end of the year with very minimal effort, versus spending 10 to 20 hours per week trading and then at the end of the year, your net cash position is maybe 150, maybe 160 to 180 if you're, you know, a good trader. What is that time that you'd have spent worth to you? Is that 20 hours per week that you're spending to trade worth the additional 60,000 that you have? If it is, great, then you should trade. If it's not worth it, meaning let's say that you're running a business or you're doing other things that it's costing you to commit time to trade, then you have to balance that and determine whether or not that's the right strategy for you. If your risk appetite is such that you can't take seeing your portfolio down and you want to take the conservative approach, that's fine too. Pick the stocks that are likely to grow at a moderate pace, ones that pay dividend, and ones that you can know quite confidently that they're not going to vary too much in terms of value. And that's okay too, because seeing 5 or 10% growth in a year is just completely fine for you because you're beating inflation, and you know that 100,000 that you have saved it's better off in a stock than, you know, leaving it in a savings account. So, you know, that's pretty much it for the presentation. You know, hopefully I would have accomplished the purpose of answering the question of what is an investor profile and how to go about understanding your profile and choosing stocks and a strategy based on that profile.